Measured, a 4.28% assessment increase on a $350,000 taxable value can become about $19 a month. At 6%, it becomes roughly $26 a month, assuming a 1.5% effective tax rate and no other changes. And if the assessor's value is actually 10% too high, correcting that gap could be worth about $525 a year. Those numbers make the envelope arriving in your mailbox look expensive. They do not tell you whether the assessment is wrong. That distinction matters because a 6% increase may accurately reflect your local market, while an assessment that did not increase at all may still be excessive. The percentage that changed is not the decision. The gap between the value implied by the notice and a defensible market value is the decision. The 4.28% figure is not a national average. It comes from Fairfax County's official figures for single-family assessments in 2026. Other documented markets have landed around the same 4 to 6% territory, but assessment calendars vary. Some notices arrive earlier in the year, some arrive later. For many homeowners, August is when this wonderfully bland envelope appears and begins a local countdown. It may not contain the final tax bill. It may not even contain an accurate estimate based on the rate eventually adopted. What it does contain is the government's current claim about your property's value and the deadline attached to that claim. So your first calculation is provisional. On $350,000, a 4.28% increase adds $14,980 of taxable value. Multiply that by 1.5%, and the annual difference is about $225, or a little under $19 a month. A 6% increase adds $21,000 of value, producing $315 of additional annual tax, or about $26 a month. That is enough to notice, especially if insurance, utilities, and maintenance have already moved in the same direction. It is not enough to conclude that the county made an error, and the base beneath that calculation is already much higher than it was a few years ago. The Institute on Taxation and Economic Policy reported that property taxes nationwide increased about 30% from 2019 through 2024. Then, Adams' analysis released in 2026 found that governments levied $396.8 billion across more than 89.6 million single-family homes in 2025, up 3.7% in 1 year. That does not mean your personal bill followed either national percentage. Property taxes are intensely local. It means a modest assessment change is landing on top of a cost that has already been climbing. Slight pause. The envelope is not expensive because the paper creates the increase. It is expensive because the paper may be your brief chance to question the value before that value enters the rest of the tax machinery. That machinery has more than one lever. A simplified property tax calculation begins with value, applies any assessment ratio, subtracts exemptions or limitations to reach taxable value, and then applies the relevant rates. Florida's Department of Revenue, for example, describes a chain from market value to assessed value, then taxable value, then millage. New York explains that some municipalities assess at full market value, while others use only a fraction. This is why a 5% assessment increase does not automatically produce a 5% tax increase. Rates can move. Exemptions can change. Caps can limit the taxable increase. A local government may adjust its rate as the tax base expands. Your property can also move differently from the rest of the jurisdiction, changing your share of the levy. The opening $19 to $26 monthly range assumes those other parts stay still. Real life may land above it, below it, or later than expected. Now, the envelope has become more useful. In a jurisdiction assessing at 100% of market value, the comparison is direct. An assessment of $385,000 implies a market value of $385,000. If the jurisdiction assesses residential property at 40%, a raw assessment of $154,000 implies the same $385,000 market value. Compare $154,000 directly with a neighbor's $350,000 sale, and you have compared different units. The assessment ratio has to be normalized first. Divide the assessed value by 40%, and the implied value becomes visible. That one correction prevents a lot of confident nonsense. Suppose defensible evidence places your home around $350,000, while the normalized assessment implies $385,000. The difference is $35,000. Divide that difference by the defensible value, and you have a 10% normalized over assessment gap. 10% is not a legal standard. It is not an official rule declaring that an appeal will win. It is a practical screening threshold. Below it, the annual dollars may be too small for your time, or the evidence may be too imprecise. Around it, the cash flow consequence often becomes large enough to evaluate seriously. Above it, the question deserves more than a glance at the percentage increase printed in bold. A home that rose 6% from a fair prior assessment may still be fairly valued. A home that remained flat can be 10% above a cooling market. One number measures movement. The other measures possible error. By the way, if this kind of housing math is useful, subscribing to Lazy Investor helps the channel a lot, and I appreciate everyone who does. The word defensible is doing real work here. A list price is an invitation, not evidence of what a buyer paid. An automated estimate can be a useful signal, but it is still a model. Your opinion of the kitchen is emotionally valid and financially weak. Recent completed sales of genuinely comparable homes carry more weight because they show where money changed hands in the relevant market. Comparable does not mean every house with the same zip code. Property type, location, living area, condition, lot, major features, and sale date can materially change the range. You are not searching for one magical price. You are testing whether the assessor's implied value sits inside or outside a reasonable range supported by actual transactions. If reasonable evidence spans from $345,000 to $360,000, an implied value of $355,000 has little daylight around it. An implied value of $385,000 is a different animal. The gap is larger, the annual dollars are measurable, and the argument depends less on pretending that two homes are identical. Even then, success is conditional. WRTV surveyed assessors in 7 central Indiana counties and found that approximately 48% of filed appeals received a reduction. That was a regional result among people who actually filed. It was not a national win rate. And it does not mean 48% of all assessments were wrong. Marion County's assessor separately estimated that only 2 to 3% of homeowners filed. Those percentages use different denominators. Low participation among all homeowners does not prove that selected cases with evidence have poor odds. And a strong result among filers does not tell you that a random homeowner has coin flip odds. The people who file may have larger discrepancies, better records, or more motivation. Selection matters. What the Indiana finding establishes is narrower and more useful. Reductions are real often enough that an evidence-backed gap cannot be dismissed as administrative theater. Added another reference point in its own analysis. Among homes it identified as potentially overassessed, it estimated median potential savings of $539 per year if a protest succeeded. That was modeled potential, not a guaranteed check. Still, it sits remarkably close to the $525 produced by our 10% example, more deliberate. And that changes what this envelope means. This was never a decision about whether an increase feels offensive. It is an allocation decision built from 3 numbers: the normalized valuation gap, the tax rate that applies to that gap, and the length of time the difference may affect your cash flow. Evidence quality decides whether the gap is credible. The local deadline decides whether the question remains available. Your time cost decides how large the expected benefit needs to be. You do not need a probability model with 6 decimal places. Start with the screen. Is the assessor implied market value around 10% or more above a defensible range? If so, translate the difference into annual tax dollars. Then ask how long the local assessment system could allow that difference to matter. On our $350,000 home, a 10% gap is $35,000. At a 1.5% effective tax rate, $35,000 multiplied by 1.5% equals $525 per year. That is the clean 1-year consequence. Not $35,000 of savings, not 10% off the tax bill. A $35,000 reduction in taxable value produces roughly $525 of annual tax difference under the stated rate. If your effective rate is 1%, the same gap is worth $350 annually. At 2%, it is $700. If caps or exemptions shield part of the value, the near-term difference may be smaller. If several taxing districts apply to the full value, it may be larger. So 10% is only the valuation screen. The rate converts that screen into money. $525 for 1 year may not command much of your attention. Duration is what can turn it into a balance sheet issue. If a corrected value affects only one tax year before a fresh reassessment, the gross difference is $525. If the same annual difference remains relevant for 3 years, the arithmetic becomes $1,575. If local rules and later assessments allow that difference to persist for 10 years, a no-growth calculation reaches $5,250. That final number is not a promise that one successful challenge locks your assessment for a decade. Jurisdictions reassess on different schedules. Some update annually. Some use longer cycles. Caps may matter more than the original reduction. Market appreciation can close the gap, while a later modeling error can open a new one. Tax rates can also change. The 10-year figure answers a narrower question. What does a constant $525 annual difference cost over 10 years? $5,250 before considering any return that money might have earned elsewhere. You may hear the phrase snowball and picture compounding inside the assessment itself. That is not necessarily what happens. The reliable snowball is in your household cash flow. Every unnecessary dollar paid is a dollar no longer available for the emergency reserve, the portfolio, travel, health expenses, or the transition out of full-time work. For a late career homeowner, that distinction is larger than the number looks. A $525 annual leak is about $44 a month. It will not determine retirement by itself. Added to insurance increases, maintenance, and an aging home though, and the supposedly paid-off house keeps presenting new monthly claims on income. Paying off the mortgage removes principal and interest. It does not remove property tax. It does not make the house liquid. And it does not turn rising ownership costs into investment return. That is why comparing the annual tax difference with a home's $350,000 value is misleading. $525 looks tiny beside the asset. Compare it with the cash you expect to have left each month after work ends, and it becomes a recurring expense with a very long memory. The timing can disguise it. If you pay property taxes directly, the larger bill is obvious when it comes due. If your mortgage servicer pays through escrow, the assessment notice may arrive first, the final levy may follow later, and the payment change may not appear until the servicer performs an escrow analysis. The notice does not reach into your checking account on the day you open it. It establishes or reports a value that can later influence the tax bill, which can later influence the escrow requirement. There may also be a temporary shortage calculation if the account collected too little for the eventual bill. That delay is why the monthly increase can feel disconnected from the envelope that helped cause it. You see, $19 in August, perhaps nothing happens immediately. And months later, the mortgage payment changes by a different amount because taxes, insurance, and an escrow adjustment arrive together. The original estimate remains useful, but now it is correctly labeled, an eventual monthly equivalent under constant assumptions, not a universal instant payment change. At this point, a higher official value can still feel like a consolation prize. Your house appears more valuable on government paper. Maybe that higher assessment helps establish appreciation when you sell. Maybe years of higher property taxes create a higher tax basis. Maybe some of the money comes back through the capital gains calculation. Firmly, it does not work that way. One house can carry 3 different ledgers. The local assessment ledger helps allocate property tax. The market ledger records what a real buyer will pay. The federal tax ledger tracks amount realized, adjusted basis, and gain. Those numbers can influence one another as evidence, but they are not interchangeable. A buyer does not owe you the assessed value. An assessor does not set your sale proceeds. and paying property tax on a higher assessment does not add that assessment increase to your adjusted basis. Your adjusted basis generally begins with what you paid, then reflects qualifying acquisition costs, capital improvements, and other required adjustments. Routine property tax is an ownership expense. It is not a capital improvement to the house. If these distinctions save you from treating every official number as one universal home value, subscribing to Lazy Investor is a quiet way to support more of this work. Thank you to the people who've already done that. Now put the ledgers together at sale. Imagine two homeowners bought economically identical primary residences for $300,000. Each later made $50,000 of qualifying improvements. Each eventually sold for $700,000 and had $20,000 of selling expenses that reduced the amount realized. Their amount realized is $680,000. Their simplified adjusted basis is $350,000. Their gain is $330,000. One homeowner's property was assessed accurately throughout the holding period. The other homeowner carried an unsupported assessment that cost $525 more in property tax each year for 10 years. Both homes still have the same sale price. Both have the same amount realized. Both have the same adjusted basis. Both have the same $330,000 gain. The second homeowner's higher assessments do not create additional sale proceeds or a larger federal basis. Under current Internal Revenue Service rules, a qualifying homeowner may exclude up to $250,000 of gain on an individual return, or up to $500,000 on a qualifying joint return. The general ownership and use tests require the home to have been owned and used as the main residence for at least 2 years during the 5-year period before sale, with additional rules affecting eligibility. For a qualifying married couple filing jointly in this illustration, the entire $330,000 gain could fit beneath the $500,000 exclusion. For a qualifying individual limited to $250,000, $80,000 would remain above the exclusion before considering other applicable details. Either way, the historical assessment does not enter the gain equation. It does not enlarge the exclusion. It does not repay the excess property tax. The two homeowners can have identical federal sale treatment and identical market proceeds while arriving at the closing table with different cumulative cash flow. One retained $5,250 over the 10-year illustration. The other sent it away during ownership. The closing statement contains no line returning it. That is the final test of the envelope. A supportable assessment is an ordinary cost allocation, even when the increase is unpleasant. An unsupported assessment is a one-way cash flow leak. The difference is not recovered merely because the house later appreciates. Look, this is why I get mildly annoyed when housing folklore treats every rising home number as good news. A higher sale price can create wealth. A higher assessment can create expense. Appreciation is unrealized until there is a transaction or new debt. Property tax is cash leaving the household now. Those are separate mechanisms wearing the same word, value. And the decision threshold is now bounded. Normalize the assessment if your jurisdiction uses a fractional ratio. Compare the implied market value with a defensible range rather than one flattering estimate. Measure the percentage gap against that range. Convert the unsupported dollars through the tax rate. Then consider how long the difference may survive and whether the contest deadline is still open. Around a 10% normalized gap is where I would stop treating the notice as routine paper and start treating it as a financial decision. A smaller gap can matter in a high tax jurisdiction or on a very expensive home. A larger gap can still be weak if the evidence behind your preferred value is poor. The threshold screens the case. It does not decide it. At $350,000 and a 1.5% effective rate, the practical line is $525 per year. If the local system resets the value next year, that is the scale. If the difference can remain operative for a decade, the no growth exposure is $5,250. The deadline decides whether you retain the option to contest it at all. The house is either a wealth decision or a lifestyle decision. Pretending it's both is how the math breaks. Quietly, with emphasis. Your assessment notice is a claim on your next year of cash flow. Reading it is the 10 minutes that can shape the years after it. Quietly, with emphasis. Your assessment notice is a claim on your next year of cash flow. Reading it is the 10 minutes that can shape the years after it.